Listen, something just happened that most people will completely misread. COMEX silver just jumped more than 5% overnight. 5%. In one session. From yesterday's close to this morning's open. That's not normal. That's not a gentle drift higher. That's a gap. A violent repricing. And while most traders are going to look at that green candle and think, nice bounce or technical recovery, they're missing the real story. Because the real story isn't what happened on COMEX last night. The real story is what's been happening in physical markets around the world while paper was crashing. And that 5% jump, that's not bullish momentum. That's paper capitulation. That's COMEX starting to acknowledge a reality it's been denying for weeks. Physical silver in Dubai is trading at $96 per ounce right now. Not yesterday, not last week, right now. While COMEX just gapped up 5%, it's still only around 76x. That means there's a $20 gap between what COMEX says silver is worth and what you actually have to pay to get metal in your hand in Dubai. And Dubai isn't alone. Australia, $93 per ounce. Canada, $89. Russia, $98. The entire world is pricing physical silver higher than the paper price. And that 5% overnight jump, that's COMEX starting to chase. That's the paper market beginning to realize it can't stay at $71 when the physical world is transacting at $90 to $98. In this video, I'm going to explain exactly what that 5% COMEX jump means and why it's more significant than most people realize. I'm going to show you the physical pricing around the world and why these aren't just more premiums, but evidence of a structural break between paper and physical. I'm going to detail the year-end balance sheet mechanics that caused the crash, why December 31st is a deadline that forces liquidation, and how institutional compliance creates artificial selling pressure. I'm going to explain China's export ban starting January 1st, 2026, why it's causing panic buying right now, and how industrial demand doesn't negotiate when supply disappears. And I'm going to give you the framework for understanding whether this 5% gap is the beginning of paper catching up to physical, or just the first step in a much larger repricing event. This is the story of how physical silver went parabolic while paper crashed, how Dubai charging $96 proved the shortage is real, and why COMEX jumping 5% overnight is the paper market's first admission that it lost control. By the time most people saw the chart, the conclusion was already written. Red candle, long wick, shooting star pattern, and instantly the narrative locked in. The bubble burst. That was the top. Silver just rejected higher prices. The rally is over. That's what retail traders saw. That's what technical analysts called. That's what the media reported. But that interpretation is dangerously wrong. Because while paper silver was printing fear on screens, while COMEX was showing red candles and long wicks, physical silver around the world was trading above the paper price. Not hypothetically, not in theory, not in some obscure corner of the market, in real transactions, in major financial centers, in verified dealer quotes. Let me give you the numbers again. Dubai, $96 per ounce. Australia, $93. Canada, $89. Russia, $98. These aren't rumors. These are actual transaction prices from dealers and refineries in those regions. You want physical metal in Dubai right now? You pay $96. You want it in Russia? You pay $98. And these prices exist while COMEX, even after the 5% gap up, is only around $76. Think about what that means. Think about the mechanics. In a normal market, when paper crashes, physical follows. When COMEX drops $12 in 70 minutes, dealers around the world lower their asking prices. Premiums compress. Physical buyers step back and wait to see if it goes lower. That's how markets are supposed to work, but that's not what happened. Physical didn't follow paper down. Physical went higher. Premiums expanded. Buyers became more aggressive, not less. And that divergence, that refusal of physical markets to acknowledge the paper crash, is the single most important signal you can get in a commodity market. Because it tells you the crash wasn't real. It wasn't driven by fundamentals. It wasn't supply increasing or demand decreasing. It was a paper phenomenon, a leverage flush, a forced liquidation. And the physical market, where actual metal changes hands, saw through it. Physical buyers looked at COMEX crashing to $71 and said, that's fake, we're not selling. In fact, we're buying more. And now COMEX gapping up 5% overnight is the first acknowledgement from the paper market that maybe, just maybe, the physical market is right. Now let me explain why physical went higher while paper crashed. Because this isn't irrational. This isn't speculation. This is survival. When you're a manufacturer in Dubai and you need silver to build electronics or solar panels or medical devices, you don't care what COMEX says. You care if you can get metal. And right now, getting metal is becoming harder. Why? Because China is banning all silver exports on January 1st, 2026. Not restricting, not limiting, banning. All exports. China, which refines roughly 70% of the world's silver, which processes ore from South America and Africa and Australia, which turns raw material into the bars and pellets that industry needs, is about to close its doors. Starting January 1st, that silver stays in China. For Chinese factories, for Chinese solar panels, for Chinese EVs, for Chinese electronics. The rest of the world, you're on your own. Find another source. Good luck. And that deadline, that January 1st cutoff, is why physical markets are panicking right now, because every industrial buyer in the world is doing the same math. If Chinese silver disappears in just over a year, where do we get ours? The answer is, you don't. Not at scale, not reliably, not at any price that makes sense. So what do you do if you're a manufacturer? You front run it. You buy now. You secure 3 months of inventory instead of 1. You pay premiums. You lock in supply before the door closes. This is not speculation. This is procurement. This is industrial buyers securing the raw materials they need to keep production running. And when industrial buyers panic, price becomes irrelevant. They're not trying to buy low and sell high. They're trying to not shut down their factories. Paying $96 in Dubai or $98 in Russia is cheap compared to the cost of stopping production. Cheap compared to breaching contracts. Cheap compared to laying off workers and explaining to shareholders why you didn't see this coming. So they pay, they buy. And physical markets reprice higher while paper markets, disconnected from physical reality, crash on leverage mechanics. And now COMEX, after spending weeks denying this reality, just gapped up 5% in one session. That's not a bounce. That's recognition. That's the paper market starting to realize it can't maintain a fiction when the physical world is screaming the opposite. Now let's move on to the year-end balance sheet mechanics, because understanding why the crash happened on December 29th specifically is critical to understanding why the 5% gap is so significant. If you're just joining us, we've established that COMEX silver gapped up more than 5% overnight, but physical silver in Dubai is at $96, Australia at 93 airs, Canada at $89, and Russia at $98. That gap between paper and physical is the story. We've already covered the divergence in China's export ban. Now we need to explain timing. Because the crash didn't happen randomly. It happened on December 29th for a very specific reason. And understanding that reason explains why the recovery is starting now. December looks normal to retail traders. Just another month. Markets open, markets close, prices move. But to institutions, to banks, to hedge funds, to clearing members, December is the most dangerous month of the year. Why? Because December 31st is not just a calendar date. It's a balance sheet freeze. It's the day when every financial institution must report their leverage ratios, their balance sheet usage, their liquidity metrics, their risk exposure. And anything that consumes balance sheet, requires daily margin, adds volatility, or expands gross exposure becomes radioactive in the days leading up to that reporting date. Not because it's wrong, not because the trade is bad, because it's too expensive to carry into year-end reporting. Let me explain the mechanics. Banks and dealers operate under capital requirements. They must maintain certain ratios. Tier 1 capital to risk-weighted assets, leverage ratio. Liquidity coverage ratio. These aren't suggestions. These are regulatory requirements. If you violate them, regulators step in. Fines, restrictions, forced deleveraging. So, as December 31st approaches, risk managers go through portfolios and identify positions that consume too much balance sheet. And what consumes balance sheet? Anything that requires gross exposure. Anything that settles daily. Anything with high margin requirements. Anything volatile. Commodities fit all those criteria, especially silver. Silver futures require daily margin posting. Silver is volatile. Silver settlements consume balance sheet. So when a bank's risk manager says, we need to free up $500 million in balance sheet usage before December 31st, one of the first things they cut is commodity exposure, not because they think silver is going down, not because they're bearish, but simply because of the accounting. The trade has to be off the books before the snapshot is taken on the 31st. They sell first, ask questions later, and plan to reestablish the position in January, after the reporting period is over. This is exactly what happened. The selling pressure on December 29th wasn't fundamental. It was institutional compliance. It was hedge funds and banks liquidating their positions to clean up their balance sheets for year-end. That forced liquidation created the crash in the paper market. But physical buyers, who don't have these year-end balance sheet constraints, saw an opportunity. They saw a fake price driven by temporary artificial selling, and they bought into it, which is why physical prices didn't just hold, they went higher. So when you see that 5% gap up in COMEX overnight, what you're seeing is the reversal of that year-end pressure. You are witnessing the institutions, now that it's January and their reporting is done, starting to buy back the positions they were forced to sell. That gap up isn't a technical bounce. It's the beginning of the paper market getting back in line, chasing the physical reality that never went away. This is a crucial piece of the puzzle. The crash was manufactured by regulatory deadlines, not market fundamentals. The recovery is the unwinding of that manufactured pressure. And the physical market strength throughout this whole episode tells you where the real price discovery is happening. Why did commodities crash right before the year ended? It wasn't about fundamentals. It was because holding these positions through year end is mechanically expensive for big institutions. But here's the paradox most people missed. The system had plenty of cash. Central banks provided ample liquidity and banks had reserves. The problem was, nobody wanted to lend their balance sheet. Repo markets tightened up and dealers started rationing their capacity, refusing to take on any new exposure. The first big warning sign? When so far the secured overnight financing rate actually traded above the Fed's discount window rate. This almost never happens. As so far is the rate banks use to lend to each other overnight using safe treasury bonds as collateral. The discount window is the Fed's emergency loan facility, a last resort for banks that can't find funding anywhere else. Normally, SOFR is well below the discount window rate because banks prefer borrowing from each other. But when SOFR jumps above it, it sends a clear message. Private balance sheet capacity is gone. Banks would rather go to the Fed for an emergency loan than lend to each other. This isn't panic in the traditional sense. It's mechanical stress. It's the financial system itself saying, we're full, we're out of capacity. And when the system runs out of capacity, positions have to be liquidated. It's not because the outlook for a commodity changed. It's because compliance rules demand it. So let's talk about the specific timing. Why did the sell-off happen on December 29th? Because that's when compliance checks are done. Institutions don't cross their fingers and hope they're compliant on December 31st. They make sure they are compliant ahead of time. They check early and they sell early. They ensure that when the reporting date arrives, they are well within their regulatory limits. This means the heaviest selling occurred before U.S. stock markets even opened, long before any major headlines or market narratives could form. Why so early and so fast? Because compliance is a mechanical, automated process. Risk management systems automatically flag positions that are over the limit. Traders get a call from their risk managers saying, you need to cut your exposure by $100 million before the market closes. They don't argue. They don't wait to see how the day plays out. They sell immediately. And here is the most critical part. When institutions need to free up balance sheet space this quickly, they don't sell the assets they dislike. They sell the assets that are easiest to offload. They sell what has deep liquidity and settles efficiently. That means commodities. Like what about stocks? Most equity holdings are off balance sheet, so they don't consume balance sheet capacity in the same way. They don't require daily margin adjustments like futures do. That's why stocks remained relatively calm while commodities took the hit. Gold dropped. Silver dropped even harder. It wasn't because the fundamentals for metals suddenly soured. It was because metals are at the very heart of the leverage system. They're used as collateral, they settle daily, and they consume a lot of balance sheet. So when institutions need to clean up their books for compliance, metals are the first to be sold. This whole crash had nothing to do with supply, demand, industrial use, or news out of China. It was all about December 31st reporting requirements and institutions needing to present clean, compliant balance sheets. Now that we're past December 29th, now that the forced selling is over, what happens next? The paper price can begin its recovery. Institutions can start rebuilding their positions. Leverage can flow back into the market. And that 5% gap up we saw overnight, that's the very beginning of this process. It's the paper market starting to normalize after a period of forced liquidation. Now we need to address the comparisons people are making because they love historical analogies. I keep hearing, this is just like 1980 all over again, or this is a repeat of 2011. I get why those comparisons are tempting. Both were huge silver rallies that ended in spectacular violent crashes. In both cases, prices spiked and then collapsed, making fortunes for some and destroying the accounts of others. But you have to understand this. Today is not 1980, and it is not 2011. Failing to see the difference could be a very costly mistake. Let me break down the structure of those past rallies and show you why today's situation is fundamentally different. Let's start with 1980. The Hunt brothers, Nelson and William, famously tried to corner the silver market. They accumulated massive positions using huge amounts of leverage, driving the price from $6 an ounce all the way to $50. It was a speculative, paper-driven frenzy. They believed they could control the entire supply by buying up futures contracts and demanding physical delivery. And for a while, it worked. But here's the key. There was plenty of physical silver available. The shortage they created was artificial, caused by a single entity hoarding the metal. When the COMEX exchange stepped in and changed the rules, implementing Silver Rule 7 to restrict position sizes and jack up margin requirements, the Hunt brothers couldn't meet their margin calls. They were forced to liquidate their massive positions, and the price collapsed from $50 back down to $10. The rally was built on a mountain of leverage, and when that leverage broke, the rally died. Now, let's look at 2011. Silver rallied from $18 to nearly $49 an ounce. This was driven by a mix of post-financial crisis fear, quantitative easing, inflation worries, and a surge in retail speculation. Online forums were buzzing with predictions of $100 silver. Everyone was incredibly bullish. But once again, the rally was primarily paper-driven and speculative. Investors were piling into futures and ETFs. There was no real physical shortage. Industrial demand was growing, but it was manageable, and global supply was adequate. Then, COMEX raised margin requirements 5 times in just 9 days. Leveraged traders couldn't hold on. They were forced to sell, and the price crashed by 50% in just 5 months. It was the same pattern. A leverage-driven rally met with margin hikes, leading to forced liquidation and a price collapse. Now, let's turn to today. And I need to be crystal clear about the difference. Back then, there was plenty of metal but too much leverage. Today, there is too much leverage and not enough metal. This is a completely different market regime. In 1980 and 2011, the problem was speculation overwhelming a market that had adequate supply. Today, the problem is industrial demand overwhelming a market that has an inadequate supply. You cannot solve a physical shortage by raising margins. You can flush out speculators. You can force leverage traders to sell their paper contracts. You can crash the paper price. But you cannot create metal out of thin air. You can't print silver. You can't magically increase mine supply in 70 minutes. So when the paper price crashes, but the price for physical metal stays elevated, that's your signal that the shortage is real. It's not artificial. It's not one entity hoarding supply. It's global industrial demand outstripping global supply. Solar panels need silver. Electric vehicles need silver. All our electronics need silver. AI data centers need silver. Medical devices need silver. And these industries need it regardless of the paper price. They don't stop manufacturing just because the COMEX price dropped. They focus on securing their physical supply. And when a major supplier like China announces it's banning all exports starting January 1st, that turns urgency into outright panic. Now, industrial buyers aren't just competing with each other. They're competing against a deadline. They're racing against a door that's about to slam shut. This creates the exact dynamic we're seeing right now. The paper price crashes due to leverage and balance sheet mechanics, while the physical price soars due to industrial panic. Then, the paper price gaps up 5% as it tries to catch up to reality. But there's still a massive gap between the two because the physical reality is far ahead of where the paper market is willing to admit. This isn't 1980, it's not 2011. Those were speculative bubbles that popped. This is industrial demand colliding head-on with supply reality. And you cannot pop physics, you cannot pop scarcity, you can only reprice it. And that repricing is happening right now, whether the COMEX wants to acknowledge it or not. So, what should you be watching for next? The 5% gap up in the COMEX price is a big deal, but it's just the beginning. Whether this gap continues to close or widens again will depend on a few specific signals. Here's your checklist. First, does the physical price stay elevated around the world? This is the ultimate validation signal. If the price in Dubai drops from $96 back to $80 over the next week, if Australia comes down to $78, if premiums compress back to normal, then maybe the physical panic was just a temporary year-end thing. But if Dubai stays at 96 or goes even higher, if Australia holds its ground, and if premiums remain wide, that confirms the shortage is real and sustained. It confirms industrial buyers are not backing down. Keep an eye on dealer quotes, premium data, and reports from people on the ground in these markets. If physical prices stay high after the paper price already gapped up, that's your confirmation that this divergence is structural. Signal number 2, what happens when China's export ban actually takes effect on January 1st? This is the catalyst everyone is watching. If January 1st arrives and Chinese silver continues to flow out freely, if the ban is just symbolic or poorly enforced, then supply fears will ease. The panic will subside. But if the ban is real and Chinese exports stop, if industrial buyers can't source their metal, if delivery times get longer, that's the supply shock we've been talking about. That forces paper prices higher because you can't maintain a low COMEX price when buyers can't get physical metal anywhere near that price. Watch for shipping reports, news of delays, and stories from traders and manufacturers. If Chinese silver stops flowing, physical premiums will explode, and the paper price has no choice but to follow. Finally, signal number 3. Does the COMEX price continue to gap higher? The 5% jump overnight was the first move, but is it the start of a trend or just a one-time catch-up? We'll be watching these signals closely. If COMEX consolidates around $76 for the next week, that suggests paper thinks the 5% move was sufficient, that it's caught up enough, that physical will come down to meet paper. But if COMEX continues gapping higher, if we see another 4% move, then another 3%, if paper is grinding higher day after day, that suggests paper is chasing physical. That suggests the gap is too wide to ignore. That suggests institutional buyers are returning and driving the price higher to close the divergence. Signal 4. Do we see evidence of industrial buying? This is the demand confirmation. If the rally is speculative, it's driven by retail and hedge funds. If the rally is structural, it's driven by manufacturers and industrial users. Watch for reports of large physical deliveries. Watch for mining companies reporting forward sales to industrial buyers. Watch for manufacturers announcing supply agreements. If Tesla announces a long-term silver supply contract, if solar companies secure multi-year purchase agreements, if electronics manufacturers lock in inventory, that's industrial buying. That's confirmation the shortage is being recognized by the entities that actually consume the metal. And industrial buying is inelastic. It doesn't stop because the price went up 5%. It intensifies because they need to secure supply before it disappears. Signal 5. What happens to the gold to silver ratio? Right now, the ratio is approximately 56 to 1. Gold around $4,200. Silver around $76 after the gap. Historically, during silver rallies driven by scarcity rather than speculation, the ratio compresses. It goes from 60 to 1 to 50 to 1 to 40 to 1 to 30 to 1. If the ratio starts compressing, if silver outperforms gold consistently, that's confirmation. That's the market saying silver is more scarce, more urgent, more necessary than gold. But if the ratio stays stable or widens, that suggests the silver rally is temporary, that gold is leading and silver is just following. Now let me give you the framework for what happens next. There are two paths. Path 1, paper continues catching up to physical. If the 5% gap is just the first step, if COMEX continues grinding higher over the coming weeks, if we see $76 become $80, become $85, become $90, then paper is slowly acknowledging physical reality. This is the orderly catch-up. It means the divergence was real but correctable. It means the system is repricing to reflect the supply shortage. It means physical holders and early buyers are rewarded. And it means new highs are coming because physical is already at $96 to $98. If paper catches up to that level, then physical goes even higher. Path 2, physical decouples entirely and paper becomes irrelevant. If COMEX gaps up 5%, but physical goes from $96 to $105, if the gap widens instead of closes, if industrial buyers completely abandon paper pricing and transact only in physical markets, then you have full decoupling. The paper market becomes a sideshow, a derivative market disconnected from reality. Physical sets the price, and anyone holding paper contracts realizes they can't actually get metal at the paper price. This is the chaos scenario. This is force majeure. This is cash settlement. This is the paper system breaking. Both paths are bullish for physical holders. In path 1, you watch paper slowly catch up and profit from the convergence. In path 2, you own the only thing that matters while paper becomes worthless. So here's what you need to understand if you're positioned in this market. If you own physical silver, this 5% gap is validation. It's the paper market admitting you were right, that physical scarcity is real, that the crash was artificial, that $96 in Dubai is closer to reality than $71 on COMEX was. Don't sell. Don't get shaken out by volatility. Don't look at a 5% gap and think that's the top. This is the beginning, not the end. If you're trading paper with leverage, be very careful. Yes, COMEX gapped up 5%. That's a big move. That's profit if you were long. But leverage in this environment remains dangerous. Another year-end event could happen. Another forced liquidation could hit. You could be right about direction and still get stopped out by volatility. Consider taking some profits. Consider reducing leverage. Consider moving to physical. Because the next flush, if it comes, could be worse. If you're short, you should be terrified. Because you're betting that COMEX at $76 can stay below physical markets at $96. You're betting that the gap closes by physical coming down rather than paper going up. You're betting against industrial demand, against China's export ban, against a decade of supply deficits. The risk reward is terrible. Cover. Move to the sidelines. Don't fight physical reality. If you're in cash waiting to enter, understand that timing entries in this environment is nearly impossible. You might wait for a pullback that never comes. You might wait for $72 and wake up to find COMEX gap to 82. Structural shortages don't give comfortable entries. They give violent entries. Either position ahead of the move or accept you might miss it. Here's the bottom line. COMEX gapping up 5% overnight is not just a bounce. It's not a technical recovery. It's not speculation returning. It's the paper market beginning to acknowledge what physical markets have been screaming for weeks. That silver is scarce, that industrial demand is overwhelming supply, that China closing exports creates a supply shock, that $96 in Dubai and $98 in Russia are not premiums. They're the real price, and $76 on COMEX, even after a 5% gap, is still artificial. It's still lagging. It's still disconnected from physical reality. The gap between paper and physical is not closing fast enough, and that gap is the opportunity. For physical holders, it's validation. For paper traders, it's danger. For those watching from the sidelines, it's a signal. Physical silver went parabolic while paper crashed, and now paper is starting to chase. How far it has to chase depends on whether physical stays at $96 or goes to $105. But one thing is certain. The paper market lost control. The crash on December 29th wasn't driven by fundamentals. It was driven by year-end balance sheet mechanics. Institutions forced to liquidate, compliance deadlines forcing selling. And while that was happening, physical markets proved the shortage is real by refusing to follow paper down, subscribe, and turn on notifications. Because we're tracking this in real time. We're monitoring physical premiums. We're watching China's export ban. We're documenting whether COMEX continues gapping higher or stalls. And we're explaining what it means as it unfolds. Comment below, do you think the 5% gap is the beginning of paper catching up? Or is this just the first step in a much larger repricing event? Because your answer determines your strategy. This isn't about short-term trading. This is about recognizing a structural break in a commodity market. A break between paper pricing and physical reality, between leverage mechanics and supply physics, between what exchanges say and what dealers charge. COMEX gapped up 5% overnight. Dubai is charging 96. That $20 gap is the story. And how that gap resolves over the next weeks will determine whether this was the top or the bottom, whether the bubble burst or whether paper finally snapped while physical went parabolic. The answer is already visible in the physical markets. Now we wait to see if paper can catch up, or if physical just keeps running higher while paper struggles to follow. If you enjoyed it, like the video and subscribe to the channel so you don't miss any updates. The next few days look promising,